Hey, happy Friday once again, options traders. Well, this video comes to us from one of the traders in our very own forum right here who had sent me a link to a video on YouTube. I'm not going to share the link, but it's just to ask for an opinion on this stop loss strategy that this person was touting. And like a lot of things on YouTube, yeah, it sounded great, sounded like you cannot lose money, which is what this person was saying, or at least you can't lose more than your initial credit. But I have no words for this other than it's just an unbelievably bad stop loss strategy. Now, for those of you who follow my channel know that I do a segment occasionally called Idiotic Ideas. Same idea here, different author. The Idiotic Ideas comes from a book, which I'm still not done digging through all of those yet. But this is from somebody on YouTube and shouldn't be a surprise there. There's a tremendous amount of bad information on YouTube. So fair warning for any of you, especially if you're new and you happen to get hooked up to a channel like this, don't be afraid to check out their credentials. Remember, to be an options expert or a stock market expert, you need 0 qualifications. And unfortunately, there's no such licensing required to be a stock market expert or an options expert. Anybody can do it. It's pretty rare in almost any other walk of life, but in the options world, stock market world, anybody can be an expert. So that's what you get a lot on YouTube. There's a lot of people that just dabble in options and they go, hey, I had a couple of successes. I must be really good. Let me start a channel and show people how I make this money. So again, my goal usually is to show people what to do, looking at the positives, but every once in a while you got to call these people out on it and say, here's what not to do. So hopefully it's still a good learning experience. So let's go find out what this unbelievably bad stop loss strategy is and why it has no shot of working. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps so much to promote the channel. So before we get started, we have to do a little background, even though I have videos in this forum. But let's just do a quick review of stop orders. Stop orders are generally used defensively to limit risk. So let's say if you have a long position, bought shares of stock or bought an option, you would place an order to sell below the current market. For short options, you would buy above the current market. And what you're trying to do is just reduce the amount of losses at some point. Now, here's the way that they work, and you have to be careful. For a stop order, we're just going to do an example with long stock. Let's say that you buy 100 shares of ABC stock for $100, and you place an order to sell 100 shares at a stop of $95 good till canceled. Now, this little $95 figure here that you have to enter into the broker's platform is called the stop price. I like to think of it as the trigger price. It's the line in the sand. And it's just saying that if ABC, if our stock here trades at or below 95, the order is activated. In the business, it's actually called elected. Your order becomes elected. And then what happens is it becomes a market order. And remember, with a market order, it is guaranteed to fill, or in this case to sell, since we're exiting a long position, but you're not guaranteed to get 95. That is super important to understand going forward. Don't take my word for it. Look it up on any exchange, look it up all over the internet. You will see that stop orders do not guarantee your stop price. It is simply a line in the sand. So here's the way that they work, at least in theory. Here's one that works well. Let's say we have our stock at 100 and it starts to slowly trail down. It's trading at 99. We still have a stop at 95. We haven't gotten elected yet. And then it trades down to 96. We still have our shares. And then it trades down to 95 or below. What happens? It becomes elected. And so if the stock is in fact 95, yes, it's a market order. And in this instance, it's going to work really well. We placed our stop at 95. We were willing to get out at a $5 loss, and that's exactly what happened. And this is what leads people to think that this is how stops work, that they're an insurance policy, and they simply are not. Because here's what can happen, and probably happens more often than not. So the stock trickles down from 100 down to 96. We still have our shares, but then let's say bad news comes out. Maybe it's earnings, or you say, oh, well, I'd never hold through earnings. Fine. Stocks will halt trading during the day all the time. They can release bad information during the day. They happen. And let's say that the stock, right after it opens for trading, is trading at 80. Well, what's the rule? Remember what the rule says. If the stock is trading at or below your stop price, in this example 95, what do? The order becomes activated or elected, and it becomes a market order. So did you guarantee that you got 95 here? No. You're going to get sold at 80. Market order is guaranteed to fill. So you bought for 100. You were hoping to get out in the worst case at 95, but you got out at 80. That is always a possibility with stops. So keep this in mind as we go forward, and you'll see why this person's strategy is just an incredibly bad idea. Now, there's another thing that we have to hash out before we get started that is a dead giveaway that you're dealing with a non-professional. I can guarantee it, this person never had any industry experience. He's just somebody that dabbles in options. And the dead giveaway is that, first of all, his title or his website has the word credit spreads in it. So he likes to talk about selling spreads. That's a dead giveaway. Remember, credit spreads do not exist. They are all debit spreads once you execute the trade. But they all think that they're getting paid, they're selling these spreads way out of the money, and therefore they've got a high probability for success. Well, if it's a popular strategy, it's probably the thing that you don't want to do. Now, also on this video, it says the simple strategy that earned 471% in 3 months. Wow, how can you not watch this video? Well, here's the problem with it. Traders like this will do trades such as this. They will sell maybe the 100-105 put spread out of the money, and they receive $1 or $100. And then they'll buy it back in 2 weeks for 75 cents. Well, they've decayed this position by 25%. They sold it for $1, they buy it back for 75 cents. That happens all the time. Every single day you can find these. And then they annualize it and say, well, this 25% times 24 periods, right? There's 24 2-week periods in a year, is 600%. So there, I just made 600% on my money. Well, but did you really make any money? They made 25 cents times 100 shares per contract, 25 bucks, paid a commission in on 2 contracts, paid a commission out on 2 contracts, so 4 commissions in total. You're talking about peanuts. It's just a really bad idea, but it looks good in terms of percentages, and that's why they never tell you how much money they made. They tell you how big the percentage gain was. So the first thing to remember is that percentages are not money. But with that out of the way, let's take a look at really the foundation of his idea. He says he's going to sell an option or a spread and, let's say, generate a $100 credit. And I think he said that's kind of his average amount. So he's just selling out of the money spreads. Now, a quote, direct quote from the video says, you don't ever want to lose more than 100% of your potential of winning. So in this instance, the most you could win is $100, but you don't ever want to lose more than that amount. All right, well, my question is, how do you do that by selling options? So if we sell, let's say, the $90 put, the stock's way up here at 100, yeah, you might pick up a couple of bucks, but don't forget you've got unlimited downside risk. So how is it possible that you can't lose more than the $2 that you could make? It's just not going to happen with short options. Well, then you think, all right, well, what about vertical spreads? Maybe I can sell the 100-105 put spread and I can collect a $3 credit. And because it's a 5-point spread, the most I can lose is 2. Well, here's an example where I cannot lose more than I can make. Very most I can make is 3. The very worst case is I lose 2. So is this what he's talking about? Well, if that's true, the only way that this pricing relationship is going to exist where you can make more than you can lose is if the stock is way out here. It's an in-the-money credit spread. And that means the stock has to move all the way up here to 100 just to get to your long strike, and then has to move up to 105 to get to the short strike or beyond for that maximum gain. So in this instance, you've got a really high percentage chance of losing the full $2. Well, that's not much of a strategy. See, he leaves out this idea that you're going to have a very high chance for loss, even though you could, in the extremes, make more than you could lose. All right, so maybe we don't go in the money, we go out of the money. So let's say you sell the 100-105 put spread for $1, and now the maximum you can lose, because it's a 5-point spread, is $4. How are you going to get this type of relationship where you can make a little bit of money but potentially lose more? Well, it's out of the money, so the stock is way up here somewhere. So this is what most credit spreaders like to do. They sell them out of the money. They think I've got a very high probability for success. The problem is it now goes against exactly what he promoted. You can absolutely lose more than you can make. See, that's always going to be true. You can always lose more than you can make with short options or short spreads. Now, again, if you go into a situation where you could only lose 2 but maybe make 3, your probabilities are super high that you're going to take a loss. So it just doesn't matter how you cut it. If you approach trading by saying, I only want situations where I can make more than I can lose, and therefore I'm on the road to riches, you're fooling yourself. All right, I've talked about this before. You can find those all day long in a casino. Go to a roulette wheel, bet on a single number. You can win $35 for every dollar you bet. There you go. There's a perfect example where you absolutely cannot, mathematically guaranteed, cannot lose more than you bet. Take the 2-number bet. They'll pay you $17 for every dollar bet. Even all the way down here to the red-black, a 1-to-1. All right, there you could lose the same amount. All right, well, maybe we just don't play the red-black bet. And we can always win more than we can lose. But as I've shown in many videos about this, they all have a negative edge. They're all guaranteed losers, some more than others, but they all have a negative edge. So to say that we're going to find strategies that only have the ability to make more than you can lose is an absolute deception. It just doesn't exist. All right, so now that we've covered that, let's take a look at this stop-loss strategy. What he's saying is that he's going to sell an option and let's say get a $1 credit or $100. And then he's going to set a stop at 50% to 100% of this credit. So we'll do an example here in a minute, but if we set a stop at, let's say, $50 to $100. All right, so if I buy it back for $150, I'm at a 50% loss. If I buy it back for $200, that's a 100% loss. I sold it for 100, I pay 200, I've taken a 100% loss. But then he says, here's another quote, you don't ever want to lose more than 100% of your potential of winning. That's why he does this first step. Now, another quote from the video, he says, once you have a winning trade, you'll never lose money, even if the stock moves quickly. So I'm thinking, well, this is going to be interesting. How is this done? So he sets out, this is the strategy. Let's say that we collected $100. This is the price that we received, and you're going to set this stop loss for $150 to $200, depending on your risk tolerances. So again, you collected $100. If you end up getting stopped out because the position went against you and you have to pay $150, then you're out 50%. If you have to pay $200, you are out exactly 100%. So you're going to lose 50 to $100. But look at this, like magic, that's the most that you could make. And then he says, all right, so far we've set ourselves up to where you can never lose more than what we made, which is not true because now that you know how stop orders work, this is definitely not true. But it looks like it's true. And then he says, all right, but some of these times it's going to move in your favor, and let's say you can buy it back for $50. So you sold it for 100. If you buy it back for 50, You've got a winning trade. And now this is where he says, remember, don't let a winner become a loser. This is important. He stresses this in the video. So what does he say to do? Set your stop order at double this, at $100. And now your worst case P&L is zero. Why? You collected $100, and if the option goes to 100, where we have to pay 100 to get back out of it, I've received 100, I paid 100, I'm out at zero. So yeah, I had a $50 unrealized gain, but I've kind of let that slip away. I could have taken this gain, but I've decided to hold on to maybe make more. But at least I've guaranteed that I won't take a single loss once this starts to move in my favor. Now let's say it moves up more in my favor and I can buy this option back for 25 bucks. I sold it for 100, I can buy it back for 25. I'm going to place a stop at 50 bucks, exactly double the amount. So again, if I received 100 and it goes against me and I have to buy it back for 50 bucks, then I'm up 50 bucks. Now notice I could have been up 75. I sold it for 100. I could have bought it back here for 25. I chose not to. I set this stop, but at least I got 50 bucks in my pocket. Now the stock moves more in your favor. I can buy it back for $12.50. Notice he just keeps chopping these in half. And so I place my stop at double this, 25 bucks. Now the worst case that can happen is I can make 75 bucks because I sold it for 100. If I end up getting stopped out, I have to pay 25 bucks. I'm up 75 bucks. And finally, if it goes to 5 bucks, I'm going to set my stop at 10, and then I'm guaranteed to get 90 bucks back. And in the extreme, if it goes all the way to expiration and expires worthless, then I can make the full 100. But we all know that that's probably not going to happen because that means you have to ride it all the way to expiration bell, and things can happen in the after hours. You can get assigned after hours. That's a very big risk. Not mentioned here, but he says that this is the best case that you could win $100, the initial credit. I can tell you that is extremely rare. And if it does happen, you are taking very big risks because there's nothing you can do in the after hours to mitigate that. So then he summarizes the strategy and says, okay, notice that up here that we've minimized our losses. By doing this 50 to 100% stop loss up here, that's the worst, is that we just lose the amount that we made up front. But if it moves in our favor, we've now managed this risk all the way through. And he says, quote, you cannot lose at any step of this way, even if the stock moves quickly. I'm thinking, really? So you're telling me if the stock takes a really big nosedive, volatility's not going to jack up? You think that you're still going to be able to buy this back for 50? You don't think the bid-ask spreads are going to widen? You think you're going to get stopped out at this number? Fat chance of that happening. At no stage through this entire process are you ever guaranteed to limit your losses to the amount of the credit. Now, the final note to talk about why this is such a bad idea, and I've talked about this in previous videos, is the idea of path dependency. And this comes up a lot in options trading and strategies. But remember, if we have a $100 stock for 250 trading days, there's a certain path it will take. You could create another $100 stock, let's say in a laboratory, give it the same volatility, turn it loose for 250 days, and it should have reasonable characteristics, but it's not going to take the identical path. And so if we did this for thousands and thousands of tries, we would get some type of a cone shape like this, and we would see a bell curve out here. Now here's the problem with these stop orders. Let's say that I'm going to use it from the buy side this time. We buy stock at 100 and we put a 95 stop. If the stock is up here and it slowly works its way down to the stop, like we saw, and you get stopped out and then it continues down, sure, you're going to look like a hero. And in that case, the stop order worked beautifully. But this isn't the only path that can happen. It could also turn around and maybe look like it was going to be a great idea because it still dipped below 95, but then it runs in the other direction. and now you're just filled with regret. And you're thinking, okay, well, the stop order certainly didn't work like I thought. Not only did it not limit my losses, it actually chopped into my gains. And so the idea to see with stop orders is that the success depends on the path of the stock. And that's what's called path dependency. However, what if you instead, let's say of owning the shares, that you bought a put instead of using this 95 stop? Well, now it doesn't matter where the stock goes or what the path is. If this is your 95 strike right here, as long as the option is alive, the stock could clip this price, you're still in it. It could clip this price, you're still in it. The stock could fall through here, you still own the shares because your insurance policy is still in effect. As long as the option is alive, you are going to continue holding the shares. You have the right to sell at 95, not the obligation to get stopped out. So the only thing that keeps this strategy working is that there's an expiration date. So as long as the option is alive, you will never get triggered out. So here we can see the success depends on time, and this is a time-dependent tool. So you have to understand that options are time-dependent. Stop orders are path-dependent. And when it comes to trading, there's a very big value in waiting. So one reason for paying option premiums is for the right to decide at expiration. Let's see how things unfold between today and expiration. But placing stops on options destroys this very benefit. It destroys the very benefit that you're paying for. So remember, there's an advantage in waiting to see what happens because there are so many possible stock paths. And if you fail to recognize that there are so many possible stock paths, you're going to fall into these traps that so many people on YouTube try to teach, and to think that there's no way you can lose money just by simply moving up your stops. It's just an incredibly bad strategy. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.